Chronicles. Hot Chris is hot off of the mother press. Not even time to go to the bathroom, my guy.
Yeah,
It's like maybe he's just gonna take a little bit of a breather, but he's fresh off of it. And unfortunately, I'm gonna make you perform today as well. We are talking about an electrical company, conduit company. I'm curious to see how they are doing, just in light of what's going on in the real estate sector right now. And then we'll talk a little bit about everything else that's going on. I'm working on an intro for you guys. So this is a part where I'd probably kick off with an intro, quick little 20-30 second video, but looked like the market held up today. SPY broke over 4,500. Oil's down. Gas is holding about flat. Nvidia is creeping up closer to 500. Apple is creeping on its way back up to $200 before it does another split likely. Dutch Bros down was about 6% today. The Qs is coming up and doing well as well today. Palantir is relatively flat. Google hanging in there, going up a little bit. And that's pretty much it. Bitcoin coming down a little bit. But other than that, things are going rather well. Hot Chris, how you doing, man?
I'm worried. I'm worried, dude. Like,
yeah, no, I got your message this morning. What to tell me what's on your mind? I have 2 years for you.
So we got this report from Walmart, and one of the key things, the messages that I got from Walmart was that they are not happy with what's coming. They're starting to see disinflation, and now technically the guy didn't say disinflation, he said deflation. So they're seeing a lot of that happen. You're seeing
in the supply chain, you're saying, or just in general, all goods.
In general, we're seeing a weaker consumer starting to come up. I'm starting to see unemployment and layoffs starting to kind of like creep in again. And especially in the small and medium-sized businesses, bankruptcies are getting higher again. So the question is, I think we are slowly headed into a recession. You know, I was hoping we had more time and that Santa Claus rally would continue, and it still might, you know, so don't take my word for it. But I think the risk of trying to eke out another 5% gain versus a flat to maybe a 10 to 20% correction is rather high. What's his name from Jamie Dimon also was a little bit leery, and he had made some comments too, like, hey, I think you guys are utilizing the CPI print as you're becoming a little bit too euphoric. So, you know, some people you just got to respect. Jamie Dimon's one of the most respectable guys. Like, he's the CEO of the largest bank in the world. You know, when he says something, there should be some weight applied to it. Walmart is the same thing. Walmart has its hands in every part of the United States. You know, there isn't a state that doesn't have a Walmart. And if you want like the heartland, middle America, you want to know how they're feeling right now, you gauge Walmart. And so if Walmart is weakening, that means that the US consumer is likely weakening as well. So I think my thing was, my expectations of a recession were never completely gone, because they were always in the back of my head. But I was hoping that we would get a softish landing, which we still could get. But we have had a tremendous amount of gains this year in a lot of companies. There needs to be some retracement just naturally. You know, you can't just have like constant year-over-year growth just go up like crazy. So if you look at what the NASDAQ is doing right now,
it's up like 38% for the year or something crazy.
And we overshot the 200-day moving average as well. I don't know if you saw that. Like literally it was just a V-shaped move above that 200 day. So
I'm sorry, year to date, NASDAQ 100, the Q specifically, is 44%.
Yeah. And so that's good for us, as you know, we were all in the NASDAQ, like a lot of the NASDAQ companies. But so there could be some weakening. Now, the thing is, I'm starting to see two levels of bifurcation happening with this. So you have
using a lot of big words. Bifurcation. What does that mean?
So you're seeing a split
on you. There you
so
go.
You're seeing a split happen where you're seeing the companies that are relatively in a safe position in terms of cash, like the FANG names. Those guys are going to do well, because a lot of people are going to be selling off the smaller, more mid-cap companies and saying, you know what, I don't want to be in a risky company. I want to be in that gold standard company. You know, the gold standard right now is the Google of the world, the Apples, the Microsoft, because All of them have the fire of AI behind them. They're growing. They have strong cash flows. If there is any weakness, it's fine because the cash flows can be used to buy back the shares and support the share price, versus more medium size and maybe even some smaller large caps that may end up being stressed during a recession. So relatively, you're seeing a lot of people look for safety. So they're gravitating towards the FANG names for safety. That's why if you look at the market today, a lot of companies were red, with the exception of the FANG names. So the FANG names actually did well today. They were actually green, the only ones that were green. The companies that I told you to buy were primarily in a sector that isn't impacted much by recession. So can you put up my Twitter real quick? I put a chart on there that's worth exploring real quick.
Hot Chris. There it is. And let me share.
Because I think this chart is like a little cheat sheet that's actually worked out well for me in the past. So scroll down.
Yeah, these charts, I know exactly when I made the trades this morning, I saw, and I love The Sopranos is my favorite show of all time, by the way.
Mine too.
You gotta give James Gandolfini some love. I know we're talking about business here, but
I can't believe he passed away.
I know exactly. You want to know exactly where I was? I was literally just touched down to Vegas. Me and my buddy, 2013. It was right before I was about to move to Texas, and I sat on the edge of the bed, and we literally just turned on the TV to watch something really quick while we were getting ready to hit the strip. We were staying at that Wyndham that you guys were thinking about staying at, and you guys set it up with the Airbnb, and I was like, you gotta be. I thought it was a joke. You know how you hear Weird Al Yankovic dies, whatever. But I was just like, no, there's no way. Show anyway. Back to business.
Dude, Laura, I am so sorry. Dude, getting a root canal sucks, man. Put that comment up. I wish you nothing but the best. I hate dude. I had one root canal, and let me tell you, boy, man. Have you ever had a root canal?
Nope, and I'm dreading the day because I've met several people that have, and yeah.
Let me tell you, it was not a good feeling. So, can you blow that up or no? I can't.
Yeah, I can blow it up a little bit more.
Okay, there we go. So usually, what happens in a business site? I did
not mean to do that. Now I'm screwing everything up.
Usually in the business cycle, these are the sectors that typically do well and underperform. So if you're looking at economic growth, it's always like this, nice. It comes in waves. Right now, by all means, I think we are in a late stage of growth, which is the companies that have done traditionally well have been utilities, which, believe it or not, this time around did not happen to be the case, mainly because of the higher interest rates, right? So utilities did not rally nearly as much, but that doesn't mean that that's not going to be the case going forward. Materials did well. Healthcare did well. If you've been in healthcare, you've seen the Eli Lillys of the world. You've seen the Novo Nordisk of the world. They've done exceptional. Energy has outperformed this year, primarily on the back of really strong commodity prices, underlying commodity prices. So those were good. And consumer staples, those were great also, So as we go into more recession, as people are predicting, the companies that tend to do well are consumer staples, right? So things that people can't live without, just because we have a recession and you may end up, you lose your job doesn't mean that you're going to stop eating food, So companies that do production around, have business around food production, they're not going to say, you know what, we're going to be impacted nearly as much. So consumer staples is one. Healthcare, because once again, if you have a recession, you're not exactly going to say, hey man, you know what, I need this diabetes medication, but there's a recession, so I'm going to go skip it. No, if you need the medication, you need the medication. So healthcare does well. Okay. Telecom, same thing. You lose your job, the first thing that comes to mind isn't, hey man, you know what, I'm going to get rid of my cell phone. No, you're going to need your cell phone. And then there's all these companies that support the cell phone and the telecommunications part of that sector. And last but not least is utilities, because once again, just because you have a recession doesn't mean you're going to stop using electricity. You're going to stop using, water. These are core fundamental things that you need in order to be there. So these are the safety sectors that you want to be in, because these are things that are not impacted by a recession nearly as much. The other companies on this list are impacted. So industrials, when you have a recession, companies stop spending money on expanding and doing capex. So a lot of hospital systems, a lot of, a lot of companies, they stop buying these things. Like, let's say right now you get a recession. Here's an example. You're not going to fly as much, right? People are going to cut back on spending on flying, which means the airlines are not going to exactly spend money on buying more jets, right? When you have a recession, industrials will take a bit of a hit. Information technology, same thing. Businesses are not going to be lining up to say, yeah, let me get the new software if I, just because it's there. When everything is good, people can go out and indulge in software products that they don't even use. They could just try it, whatnot. Usually they'll cut back on this. Financials is the same thing. As the consumer weakens, you're going to see a lot more defaulting among consumers. So if you lose your job and you have an outstanding personal loan, you stop paying it. You don't pay for 90 days, that company is going to have to recognize that as a loss and send it to loss prevention and all this other shit. But your concern isn't, hey, I need to make sure my bank is getting its money. Your concern is, hey, I need to survive. So I'm not exactly going to be doing a lot of loan originations either. So banks typically stop lending money in anticipation for recessions. And also during a recession, they're not exactly in the mode to make more loans, which is how they make money. And then also the loans that they do have, some of them are going to default. Like, look at the auto loans right now. The auto sector is absolutely, the number of delinquencies is just skyrocketing. So financials don't typically do well. And same thing with materials. People cut back on spending, which means that you don't need as many materials anymore. So, that's where we are in this. And so the companies that I told you about, I've been keeping my eye on for the last year, and I've been modestly investing in them, but I figured, what, let's go into defense mode. I think that's the key right now. We need to be in defensive. All the gains we've made for the year, let's take them. Let's get into defense mode. Let's secure that capital, keep it ready and dry, because when the opportunity comes on the other end of this recession, I want to make sure that we're liquid, we're ready to go, and we're piling our cash into the best opportunities that come our way.
Yeah, I don't agree. I think that, we've been seeing this come, and I think that what might be happening is now, people are actually speaking a little bit about it. To me, I believe the recession was last year. I think that we saw a lot of issues with what was going on in the tech sector. We saw a lot of layoffs, and we've only really seen, to me, less than a year's worth of turnaround associated with that. And I just find it very hard to believe that you have last year 2 negative quarters of GDP growth, and within a year's time, you're going back into recession. I think in reality, what's kind of happening is we're truly just starting to see the impacts of what's been going on with these rising interest rates. And now we're getting to a place where, there's going to be some tightening, but I think that that's usual. I mean, you're seeing things like energy underperform over the last year. You're seeing information technology performing really well over the last year. Financials is probably the only one that I would say that is not doing also well, just because of the rising interest rates. But to me, I think that we're more in like a early transitioning to maybe a mid recovery right here. And I think that a lot of that just has to do with the fact that things are just so out of skew with what happened in 2020 that we're used to these, I would say like 8-year cycles and stuff like that. And what we really ended up with, I think, is just like what we think is typical is not really the case, right? I think in 2022, everyone's saying, well, we weren't in a recession. And then it's like, that's bullshit. We were completely in a recession. There was mass layoffs in the tech sector. Was it as bad as people probably wanted it to be? Probably not. And was it a typical recession? Probably not. But at the end of the day, like, I felt worse last year than I do this year. And maybe that's the looming part that you're kind of getting to. But even during the pandemic, when people were getting mass layoffs and the oil industry was literally at its lowest, which, keep in mind, it might not matter much for you guys, but it matters a lot for me. Being somebody that's, working in the deep water Gulf of Mexico, that's generally where spending starts the first, right? They cut that quickly because that's big bucks, right? Well, one of those drilling rigs costs $1 million a day to run, and we can get into that in the future. But to me, like, I didn't even feel that scared during the pandemic comparatively to how I felt. I would wake up sometimes being like, when is this going to end? And we're talking about in 2022. When is this going to end? I'm literally down a house right now. The house that I'm in right now, I could have bought cash with the amount of money that I had lost in 2022 in my portfolio. So it's like that sort of scaredness of being like, sometimes I don't want to say short of breath because it makes it seem a lot worse than it was, but I would talk to people. I'm like, I don't know, and what I mean by that is during the pandemic, it was very easy for me to be like, what's the go-to scenario? Just like you said, let's buy some peanut butter and jelly, like, so we can make some PB&Js. Let's buy the ramen so we can put every single dollar into the market. And that's what I was doing. I was putting as much money into the market. I wasn't doing anything other than putting money in the market. In 2022, I was sitting there scratching my head, and it was just like, you're watching it, and it was down, and it was down, and it was down. And a lot of people, I don't remember if you remember watching the TV, maybe you did, but it was a lot of people were comparing that to what was going on in 2008, 2009, retracing, putting all those things next to each other and everything to like. So to me, where we've been over the past 10, 11 months is a recovery from that recessionary sort of feel. So maybe, and who knows how it's actually going to play out. But I think to me, with what's going on and in interest rates, 6 months from being kind of loosened, I think at the end of the day, it's going to be something where we continue some sort of rally. And I think where we're really being impacted is it's been going on for so long, and all these things and people have been talking about it, but we've seen this recovery in the market, that the recovery in the market, I think for us, has dulled our true feelings for what's actually been going on. And I think maybe now people are starting to pipe up about it. Jamie Dimon's been talking about some sort of dark cloud for the past 12 months. And, maybe he's right. Maybe something will come in the next 6 months. And maybe you're right, Chris. I respect you, and I agree with a lot of what you say. So, I mean, I could be the one that's being blinded here, but that's just my thoughts. I think that we're still in this.
I think the key is we have to apply a little bit of risk management here.
For sure. I wanted to say this, and I didn't, so I apologize. I don't think that we will see a 20 to 25% decline here. I think we might see a little bit of a pullback, and I think that that's normal. I could easily see a 5 to 10%, just like what we did, where we were probably since July to about now. We saw that kind of full cycle of down 10%, going from 4,500 down to 4,100, and now we're back. I could fully see that happening again. But to me, I still think that we're on the up and up. I don't think we're pulling back 20, 30%.
I mean, maybe 20, 30% might be a little bit too much. I think that it's going to be a lot more shallower than people are expecting. But just for me right now, I'm looking at two things. From a risk to reward standpoint, I'm looking at valuations, which are, pretty high. And on top of it, if I see that valuations are high and the expectations are somewhat muted on a recession basis, because I think a lot of people recently have been giving it the all clear, including myself to some degree, until I started to really dig into the numbers. Like I said, I don't think that we're going to see like a major recession that, brings everything down. But from a risk to reward standpoint, I think the best thing to just be is defensive for a little while and just see where things go. It's almost like, hey, listen, I just want to watch, like you're already up. You just kind of want to sit back a little bit and watch.
So you're saying yes, you're not saying go to the bomb shelter. You're saying 5 to 10% cash is probably good. Is that what you're kind of saying?
Yeah. I'd say probably 25 to 50% cash,
God damn,
but
Chris, what the
not
fuck?
so much cash. I'd say that be in assets that you know are going to be insulated against a recessionary environment where you can still make money. That's the key. You have to make you it's figuring out how to make money during the down times. It's easy to make money during good time. You just take a dart, you throw it against the S&P 500 and you buy the stock. During growth, you'll make money. The problem is, can you be good enough to buy those companies that are going to outperform the market during a drawdown? That's the key. So one is capital preservation and liquidity. That's one goal. But then the other goal is also, how do you make money during a downturn? Do you do covered calls? Do you do preferred shares? Do you buy bonds? Like, what is the goal here? And so that's where I'm positioning my portfolio a little bit, to just take advantage of a dislocation that I'm seeing right now in a sector that will benefit significantly from rate cuts, but also at the same time, their valuations are relatively, are really good. And if you have a long-term mindset, you don't care about recessions and all this stuff, dude, I totally implore you, just hold on to your stocks. Eventually things will go down and they'll recover. If you have a long-term mindset, totally, that's not a problem, but for someone like me, who I think I can gauge market sentiment, I think the goal is right now to just apply a little bit of common sense and a little bit of logic and just say, okay, am I trying to squeeze out an additional 5% gain from all the crazy valuations that we already have? Or do I want to try to safeguard and take my money off the table for a little bit? And if I do miss out on some gains, I'll miss out on a 5%, maybe 10% run up. Whereas the risk is a 20% drawdown. So just from a risk to reward standpoint, I'm like, okay, I will take a step back and just woosah a little bit.
So let me ask some hard-hitting questions, Chris.
Sure, go for it.
Did you sell your Google spreads?
No. Google is fine. Google, like I said, this is a bifurcated recession. Google will do well. Okay. They're very undervalued for where they should be in relatively speaking to the other companies. And I think Google is the safety play. So I think a lot of people, as the market turns, people are going to say, "Oh my God, I need to be in the equity market, but I don't want to be in."
But that seems counterintuitive, Chris. I mean, I love you, but your little chart here says, and I'm not trying to like shove it in your face, right? I'm just like, I'm trying to understand the reasoning. Is like the information tech, to give everyone its eyes into this upper part is outperform the equity market. This bottom part is underperform, right? So overperform, underperform. No, I'm just kidding. The information tech piece for late and recessionary, no bueno, right? And that's kind of where I'm like, I still think that we're in kind of this beginning piece because we just have been a year's worth of on a bull run. If you think that information tech is going to continue to persist well, but you're not saying all information tech, you're just saying well-capitalized information tech.
Yeah. Right? I mean, so look at all the other information technology companies that have been smashed over the last year. Microsoft, Google, Amazon, these are outliers. They're not the general market. So like, let's look at some IT companies that have absolutely gotten decimated. All right. Let's look at one, Confluent. Confluent is probably the best example. Hold on. You know what? Let me actually just pull up FinViz, and we'll just go based on the sector. Sector.
Yeah, I like FinViz a good bit.
Communication services. Where is technology? Okay. So,
but somebody just, while you're pulling that up, somebody asked how long I was in Trinidad. I was in Trinidad for a year. I was supposed to stay for another 2 years, but unfortunately the pandemic happened and the company made the decision to move me back to the United States.
Okay. So these right here, this is technology. I'm not sure if this goes into just information technology. Oh, here it is. Information technology services. Okay.
FinViz is great, by the way, for anybody that's never used it. It has a lot of great information that you can dive a little bit deeper. I think it's a little bit more accurate than like a Yahoo Finance personally. So just keep that in mind.
So I'm going to do over 10 billion because over 10 billion will give us the best indicators for like the general companies. If you look too small, you won't see much, right? So this is performance of information tech above. These are large companies, right? Why is it showing only this? Well, let me just do any for now. This way. Okay, so these are all the. Hold on one second. These are all the companies in technology that have been taking a hit. Okay, you have Paycom, you got Enphase, Nokia, Keyence is what you do. This is Keysight. I don't know what Keysight is. Zebra is down 15%. Trimble is down. Aspen. I mean, there are companies that have done well too. So don't get me wrong. Like Dell has done okay. Dell's up 80% year to date.
Intel's up like 45% as well. It's pretty fucking crazy.
Holy shit. Asana, IoT,
Uber, god damn, what the fuck?
Yeah, Uber really killed it. Broadcom is up, FICO.
There's your SMCI though, guy.
Yeah.
Almost at the peak.
You know, it's funny that I'm looking at these numbers now and I'm just like, wait a second. How is this possible? Maybe let's look on the mid cap size. Maybe the mid cap was bleeding. Most of the bleeding was.
This is the thing, though, Chris. Like all these were bleeding in 2022 as well, so that's why I'm a little bit confused.
Well, maybe that's because a lot of these. Okay, so a lot of the large ones probably ended up getting repriced into mid cap. That's what I'm thinking right now, because I'm looking at the numbers for some of these companies. Right, they were. If you're down 70%, you were a large cap, and you're down 70%. Now you're a mid cap. You know. So, like an example is DocuSign. Like DocuSign at one point was what was it? Damn. This is the one thing that sucks about FinViz. I never know what the I don't know how to go further back.
Go to a weekly chart instead of a daily.
Let's see. Yeah, look at this is DocuSign, right? DocuSign during the pandemic was just on fire. They were at $306. Now they're trading at 46. So they went from large cap to mid cap, you know. So that's what I think is the discerning factor here. A lot of large cap ended up going into that. Like Toast was another one. Toast, when it IPO'd, was like doing really well. And then look at this. Just red candle all the way down. And I see Toast everywhere.
This is where I'm still confused though, Chris, because it's not like it's just getting hit, right? Like it's been hit all year, and it was hit last year in 2022 for most of these as well. And like a lot of these peaked, these smaller technology companies or even mid-sized technology companies peaked in November, December 2021. And throughout 2022, we're bleeding, and some of them even still to this day are bleeding. So I'm just trying to understand what's really changed for you to think that we're still going into some sort of recessionary period when a lot of these are really massively impacted already.
Well, there's a couple of things. I'm also seeing a lot of layoffs in the space. Like, I don't know if you've seen that. You've been tracking those in IT. Like, we had giant layoffs in January, but recently we've started to see a lot of those layoffs start to come ahead too. You know, this leads me to believe that either the businesses are seeing a slowdown in business, or that their capital is kind of dried up and there's really not a lot of room for them to exist without that strong funding that they typically got when when rates were a lot lower. So, that's where I'm. DocuSign has competition from Dropbox. Yeah. So I think right now we are in the beginning stages of a recession. So I wouldn't want to be in the more speculative side of speculative companies. I'd look for value companies right now that are in sectors that are absolutely necessary for the consumer to thrive in. But we can disagree on it. That's not a problem. Yeah. You think we're going higher? You think that this is
I think we'll see a little bit of a cool off, but I think that, I just feel like generally speaking, December is a very positive month. November is very positive. We've done really well. I think we'll end the year pretty strong. And I think that with what's going on, like, I don't understand why right now, unless some serious headwinds, like mortgage delinquencies pick up, which I know they have, right? But I think that when you start to move a little bit further along and in the collar gets loosened up a little bit, I think things will kind of go back to normal. And I don't expect it to go to like 2%, right? From 5 to 2. I don't expect that. I mean, I expect half a point every couple months, if that, maybe a quarter point to start with. I really don't know, but I just don't really see it really getting impacted all too much. I just think that the Fed, I think they're doing a better job than I would have probably thought earlier this year when there was a lot of the layoffs announced in the Googles, the Amazons of the world. And I think that, a lot of companies are being a lot more cash conscious than they were in the past. And I think that I think a lot of that has to do with just the typical tightening and people not having as much cash. And the people that aren't, NextEra Energy being one, Orsted being another, they're getting slapped. But I think those are the folks that will, if they know what they're doing and are in good businesses that have really good ROCEs, return on capital employed, I think that they'll power through. And when the time comes when people are starting to get back to putting a lot of capital to work again, I think that they'll be the ones that are already flying sky high. And the fact that you've seen them already get impacted so much, to me, means that there's either an underlying recession that's been going on for the past 2 years or so that people are kind of like turning a blind eye to. Like, I think a lot of news people turned a blind eye to all of last year because they're trying to come up with some narrative, or that the recession is years away. But we will see.
I think the recession this time around won't be as bad as we've seen in the past, or at least that's the assumption I'm making right now from what I'm seeing. That could change. Everything is data driven, right? So the more data comes out, the more we can actually make a determination whether this is going to be a deep or a shallow recession. But everything, my original thesis was we don't see a recession. Now it's, hey, I think we see a shallow recession. And I'm hoping that we don't get into a deep recession. The only time you get into a deep recession is usually during like a credit event. If there's some kind of macro credit event that no one's really forecasting, that could send it into a tailspin. So that's something that isn't on my radar right now. But I would just say I'm just applying more caution, and when it comes to cash, sitting in cash, there's no better time to sit in cash right now because you're actually getting a decent rate of return to be in a cash-like position.
Yeah, June put it here. I mean, like when we were talking about this in 2021, 2022, early 2022, I mean, like you barely got anything. My Amex personal savings, I put $500 every pay into that. It wasn't ever paying me anything. Now I'm actually getting a little bit of love, right? So.
Yeah, the wife just came home, so she was just talking to me.
Oh, there you go.
Yeah. Yeah, no, just right now, I'm not selling Google. I think Google is going to do well. They've got the tailwind of AI behind them. I think the biggest thing that we are likely to see is just some pullbacks. A healthy pullback in the first few months. I do feel like I am a little early. I'm not going to lie. There's a part of me that's like, hey, Chris, are you sure? Maybe Santa Claus will come to rally for the rest of the month of December and November. And that, there's another 5-10% that you could possibly be missing out on. But my whole thing is right now, let's just chill. Like don't be greedy, just chill. Regional banks, most of them been smashed so hard that there's really not much room for downside. They'll actually benefit from the market looking ahead and saying, hey, lower interest rates are coming. So during a recession, they actually may end up outperforming what a lot of people's expectations are. So, just keep that in mind. There's really not a lot of room for them to go further down without teetering on bankruptcy for some of them. That doesn't mean it can't happen, especially if we get like some kind of like serious event with commercial real estate, which is like the main concern right now.
Right.
I am not as concerned because I think the Fed will be smart enough to react before things get really bad. But then again, you can never really make a conscious bet on how someone else will react. All you can do is just be driven by data.
Yeah. So I did want to, somebody asked earlier in the chat. So I know I preach, the triple Q, and I also preach SPY. But for those of you folks that are less oriented to write cover calls, don't have that will to do so in the future. Somebody's asked about QQQM, and I think QQQM is a decent alternative. There isn't actually a lot of difference in terms of what QQQM and QQQQ do other than the expense ratio. So it's basically the same exact companies. It's just a slightly different and cheaper price for QQQM. And I think that that's a good opportunity for people if they don't want covered calls. The reason why I do SPY, which actually has a slightly higher expense ratio than things like VOO or IVV, which are all S&P 500. They're all just different people that are kind of providing it, different houses that are providing it. SPY is the most liquid. The spider is the most liquid of all of them. And so VOO, IVV, those are still S&P 500. But if you look at the options chain for those, it's fewer and far between, less expiry dates, all that sort of stuff. Versus SPY, it's like you could almost write an options contract every single year. And same thing with the Qs. So, I think it's all to each their own. If you want to invest in VOO, you're a more long-term invested guy. You don't want that expense ratio. That can add up, But to me, being somebody that does write those covered calls, that flexibility for options, it's 0.07%, right? So, 0.07%. So it's not a big change. Having a better options contract for 40 or 50 contracts a year is better for me than paying that 0.07% of a percent less and having less optionality for my options contract. So, just because a stock is out there, just because I'm investing in something, you always have to recognize what's the underlying reason why. So when I invest in, I say SPY because it's easy to say rather than S&P 500, but that can mean VOO, that can mean IVV. So anyway, that's just some thoughts.
I have an interesting idea. Interesting idea. Well, let's do every day that we do this pod, let's do a quick, maybe 1 minute of just where the market performed that day. So here's an example. Let me just share this heat map and we can just go over what happened in the market today. And we can make some commentary on that, right? So
you said everything was red except the big 7 there, Chris.
Hold on.
Where's the poop?
Hold on. So oil and natural gas, that got beaten up today, primarily because oil prices have been going down. And I think the Russians made some commentary around that. So that's down, right? You had communications down, like Cisco was down primarily because of weak earnings from Palo Alto Networks. You had also Walmart take a pretty big beat.
Damn. Wally World down 8%. What's it down?
Yeah,
130 again?
Walmart down 8% today, man. And the softness in the CEO was kind of palpable. And then you also had autos get smashed a little bit. So autos took a hit. Now, the reason why this looks so green is primarily because FANG outperformed. FANG did well. FANG did 1.7 here. Microsoft did 1.7. And because the S&P 500 is heavily market weight average to these guys, it looks like we did okay. So if you look at the performance, it doesn't look that bad. But that's primarily because of these guys right here. Intel actually had a really good day. I'm not sure what caused Intel to rip, but Intel was there. Regional banks today were actually down. So you can see here, now they've become such a small part because they've all been smashed 70, 80%. Usually this is a much bigger amount, but JP Morgan, which is the safety bank, went up a little. So, a lot of people I think are taking risk off and putting it in more secure names. Berkshire rode up today, probably because Apple rode up because 50% of Berkshire is here. Everything else looked okay. Utilities were slightly higher. Like I said, there is a rotation happening, in my opinion, of people getting into more safety plays. But we'll see. We'll see what happens.
Do we want to talk briefly about the moves we did today in the portfolio, the public portfolio, or is that for another day? I mean,
no, we can do it quickly.
Okay, let me just hide the account number. I got to find a better way to do this than just scribbling over it every time.
Yeah.
But let me just double check. Yeah, we should be good with that. So, Hot Chris, as you guys probably saw on my tweet earlier, he reached out and let me share the entire screen. He reached out, messaged me early this morning and said, recession has been proven. Everything's going to zero. Sell. What did you say to sell, Chris?
DPST.
So we sold DPST. We made a little bit of money on it. You can see we're up. I forgot to do this, Chris. We're up to $672. That's not gains. I took the money that we should be expecting late next week, and Chris was like, let's buy. So I was like, all right, I know this money's coming. So I cheated a little bit, but if the money's very different, I'll take it out or put it back in, whatever it's supposed to be. But it's supposed to be like just about $175. So I added it in. And what'd you tell me to buy, Chris?
So there's 3 companies. Number 1 was Verizon because we didn't already have it.
No, we did. We had a share.
We did? Okay. All right.
So, I bought one more.
Okay. Oh, okay. That's why. Okay. So Verizon, American Tower Corporation, and CCI. So Crown Castle.
So I only bought half a share of AMT because we're poor. So we'll get there. We still, I think, about $40 left over.
Yep.
I bought some ABCL just because we only had, it was such a small weighting. I think we only had one share. And so I was like, so let's get that up. So I think eventually when we get a little bit more capital in here, I think it's going to be a little easier. But like I bought half a share of AMT and it was 15% of the portfolio. So I was like, we got to do something about this. So I just made a little bit of adjustments, but we bought a whole share of Crown Castle. Disney's doing pretty well as well. But overall, I mean, you can still see the portfolio still doing well. And even that ABCL buy that we did today was well timed because we're still up about 4%. So
nice. And we also added TLT. TLT is a good little hedge against a possible down. So it's like to me, it's a cash-like position that generates monthly returns. And at the same, we didn't buy it today. We bought it the other day. So right. So I would say right now my positioning is go long on the TLT for a little bit. Use that as a cash-like position because it's very liquid. You know, the capital appreciation will be there if rates go lower or at the anticipation of rates go lower. The anticipation of rates is what drives TLT, in my opinion, more right now than the actual rates being cut. You know, so if you think long duration bond, if you think deflation is coming or disinflation is coming, you want to be in long duration bonds. So that's why if you look at the 10-year Treasury today, it's actually been
while you're pulling that up, I'm gonna figure out what our new dividend yield on our portfolio is because I'm excited.
Okay, so right now you can see the 10-year is down again. Now it's at 4.4. Kind of crazy handle if you think about it. Just where we were less than a month ago, we were almost at the 5s. We've literally gone down 560 basis points.
That is insane, actually.
Yield. Yeah, it's crazy, right?
It's insane. And so you think that we're going to wobble a little bit back and forth until we kind of get you think we're going to play seesaw until we actually get this rate cut, or do you think it's going to continue closer to 4% or what?
I don't know, man. The bond market is projecting a recession. That's what I'm thinking. I'm looking at that and I'm just like, what is the bond market telling me? And the bond market,
somebody said that earlier, and it's true, right? So the we talked about it in previous streams, which is the inverse yield curve and how that kind of predicts recessionary moves. And so that being said, anyway, but portfolio right now, just where we're at 2.99% hot, Chris. And actually, believe it or not, the cash that we have in the portfolio yields 5%. And that's not a CD. That's nothing. I'm literally looking at it. Cash held in money market, 4.99%. How cool is that, man? I've never seen that before in my life. I have to check to see what the hell my Amex is doing because I might just throw it all into my brokerage. I don't know why I'm saving any damn cash and holding it up in a savings account. It doesn't make any sense to me.
Yeah. Let me just share one video that we can discuss. 1 second. Sharing the screen.
So what Hot Chris is saying is he's going against Tom Lee, right? But Tom Lee also, he switches, he kind of flip-flops a little bit depending on the month as well. So
For more on what's ahead for Walmart, its competitors, and the outlook for consumers, let's bring in Bill Simon, the former Walmart U.S. CEO. He's now on the Darden Restaurants and Hanes Brands board, so you really got your pulse on the consumer. Bill, always good to see you. You know Walmart better than most people out there. What did you make of the guidance and their cautious commentary? It seems like they had to give that cautious commentary. I mean, we effectively got it from Target in the form of their very, very wide forecast for the current quarter.
Yeah, sure. I mean, I think the reaction in the market was a huge overreaction. It was probably an overreaction earlier in the week when they ran up, and certainly today. It was a good quarter for them and a cautious outlook, which is probably necessary because when you pull apart their report, a lot of their growth was in food inflation. They're still talking mid-single-digit grocery inflation, and that's what their food business was up. And so, you pull that out, they did really well in their health and wellness and pharmacy business, and then their broad lines, the hard line and soft line business was down, similar to Target, not as bad as Target, but similarly to Target. So I think, you're looking at a consumer who's starting to have to really be considerate of their purchases, which is indicative of us heading towards a downturn. In a recession, and you heard this in Walmart's announcement this morning, they buy deals. So Halloween was really good. The promotional period was really good, but it slowed down after that. My expectation is they'll have a pretty good Black Friday season. It's now elongated, but a pretty good Black Friday season, and it'll slow down a bit. And when the consumer gets stressed, they buy deals, and that's what we're seeing now, which is not a bad thing. Broadly, it's a good thing because it might indicate that the Fed's action is finally starting to slow things down enough so that inflation will cool.
Hey, Bill, it's Tim. So you've sat in the chair where, even though your daily job was to focus on the operations, you cared about the multiple of where your company traded. Walmart trades at a premium. Does it deserve that premium? And I talked about advertising. I told about Walmart Plus. They've made a lot of investment in technology. And you say in your notes that investors kind of feel like they have to own Walmart if they're going to own something in retail. Why is that?
Well, I mean, they're a beast, right? And, just the size and the scale and the amount of investment that they've made in the last 10 years is astounding. I mean, they've grown their top line $100 billion in the last, say, 8 or 9 years, and actually have a lower operating income than they did 8 or 9 years ago. What that really equates to is just a massive change in the company, in the infrastructure, in their digital capacity, and the businesses that they're building. So, as a long run play, they're just going to be really, really difficult to beat. In the short run, you can bet against them. They're going to have to anniversary this food inflation and the growth that they've had from that, and that'll be a challenge. But in the long run, yeah, they probably do deserve to be an outside multiple.
Bill, you've talked about the self-inflicted wounds at Target for a while. Will this be the quarter when you look at operating margins came in much better, 5.2%, inventories down almost 14%, against sales growth of only down about 3%? Will this be the quarter we say that Target figured it out and that multiple should be obviously not a premium to Walmart, but it should start to catch up?
I do think so. I mean, look, Brian Cornell is a great
You're on mute, my guy.
Fundamentals. Okay, they're going too much into the fundamentals of like the corporations now. So let's.
That's the thing. That's the thing, Chris. Yeah. I know you're talking about this, but it's like I see competing things. Like I know Walmart has talked a little bit about this, and at least what you said. I mean, I didn't really listen too much about the earnings report, but you are seeing other companies report good numbers, right? And so it's confusing to me where you're seeing two sides of the coin, right? Some companies are doing well. Target reported better operating margins, like they just said there. So they obviously blew out the numbers, and they were up significantly yesterday. I don't know if they were traced today or not. I didn't really look. But regardless, it's like you're seeing two sides of the coin. Neither is really pointing to either extremely bullish or extremely bearish, right? To me, I think that people aren't pulling out second mortgages like they were last year to buy eggs, or maybe that was earlier this year. I don't remember. But regardless, it's like, I think people have come to the point where they're not as, I guess, surprised when they go to the grocery store. It's more of the same, right? So it's not like it's like, okay, well, if you're comparing to last year, of course, but it's not like they are having to think about it again and again and again. It's more of like, man, wish it was better like it was last year. It's not like, man, I can't believe I was here like a week ago and prices are, up even more since then. So to me, it's like, I feel like it's neither here nor there, which to me, me, I'm more of a perma bull. So anyway, just
there's one other thing that Jeff Gunlock, sometimes he gets a little bit too animated for my taste, but he does once in a while drop the occasional gem, and so Jeff Gunlock is known as the Bond King. Literally, guy just breeds bonds in and out, in and out. And one of the interviews that I saw last week is actually very interesting to see. Let's hear some commentary on that.
And I'm going to come back to you, and I'm going to come back to Stan in a moment. But I want to get to Steve Leisman, Jeffrey, who's come out of the room. Steve, the biggest surprise to you was what? It's clear to everybody, and he was explicit in his own words, Jay Powell was, in this move in interest rates, what the bond market has done that he doesn't have to do. I mentioned where rates were on the last meeting, 4.34. We've been talking 4.9 of late. So that's had a dramatic impact, hasn't it?
Yeah, it has, Scott. And I want to go back to what I said on your show at noon, which is I thought there was a risk that Chair Powell would use this meeting to redirect the market towards the possibility of another rate hike. He chose, I think, not to. He said there's still a bias to hike, but he didn't sound incredibly excited about that bias. He seemed willing to sort of say, you know what, yeah, we're still thinking about whether or not we ought to hike again, so that's where the bias is. But he didn't rely, as he has in the past, on the September forecast that called for an additional hike this year beyond what they've already done. And I think it's really interesting what Mr. Gundlach is saying right there, because where we are right now on the 10-year, Scott, is we've kind of wiped out the increase in yields that really strong retail sales report. So at least in the 10-year, that's gone. And I think where we're at, the idea that Jeff is saying that this is a possibility of a bond rally, what I think one of the things the bond market has been waiting for is an all-clear signal from the Fed that at least there's not going to be additional hikes. And we can get into Jeff's very interesting comments about whether or not the Fed actually needs to cut because of the deficit reasons. But I will say the Fed will at first not do any of that stuff until it feels secure on inflation. But that being said, the idea that the bond market has rallied to this point where it doesn't have quite a green light, but it's not like afraid of an instant or all of a sudden red light anymore. It's really yellow going to green when it comes to getting the go signal from the Fed that at least there isn't this very strong bias to hike again. I think that was an important change in the chair's tone today.
Even so, Steve, it's striking to me that here we are some 18 months into this regime of hiking interest rates. You know, historic move, right? 500.
Yeah, I think he's right on. I mean,
thank you, as always, Steve Leisman, senior economics reporter. Back to Jeffrey Gundlach. Jeff, do you want to react to what Steve Leisman just told us?
Yeah, I think he's right on. I mean, I think that somehow the tone seems to have changed. I feel like there's a good probability that in December, when we get dot plots, I have a feeling they're not going to be as aggressive as the current dot plot. And I also think that the shape of the yield curve is extremely unstable at this point in time. We have an absolute flat as a pancake yield curve. We had that inverted yield curve of 108 basis points, 2s to 10s. That's basically completely gone. This is the classic action that one gets prior to recessions. You get a yield curve that inverts, and people talk a lot about it, and like it's very inverted, but it hangs out there for a long time. One point that I've been trying to mentor the young people in the investment business is everything takes much longer than you think it's going to. The yield curve inverts, and everybody says, oh, we're on recession watch. No, you're not. It has to be inverted for like a year and a half, but that's already happened. And then it has to de-invert, and that has now happened. We also have the unemployment rate. While low, it is now noticeably trending higher, and it's above its 12-month moving average, and it's about to go above its 3-year moving average in the first half of next year. That's very recessionary. We also have consumer confidence, and that has started to deteriorate in terms of people's view of the present, and that's starting to close the gap between the always cautious view of the future and the view of the present. These are very recessionary signals. And so I really believe that layoffs are coming. I think we've seen hours come down. We've seen hiring freezes. And now we're starting to see layoff announcements, not en masse and not on but they're out there in financial firms and technology firms. And I believe that's going to spread. Mm-hmm. So I really believe that we're going to get this bond rally. I think the short end is going to come down. And I hope it happens sooner rather than later, because we can't afford this government that we're running at today's interest rate level. It's completely unsustainable. And I always seem to agree with Stan. We seem to have that same sort of Eeyore mentality about analyzing the government's finances.
What did you think of that, Matt? Do you think he's right?
I mean, I don't. I don't know. I understand where they're coming from, right? I understand the individual yield curves. I just feel like everyone is just, for some reason, feeling so doom and gloom, and I still think like we're still a little bit away from it. And I guess my question to you, Chris, is when you say recession, I mean, what do you think that means? I mean, you said a little bit like you don't think it's going to be a 25% pullback or anything like that. But what does that mean? I mean, to you, does that mean a 15%, 20% pullback within the next 6 months? I mean, what are you referring to? Because to me, I just think that we're still a little bit of ways away.
To be fair, I think right now it's going to be a very shallow recession, so not that much. Maybe SPY hitting 380, so that's not a lot. That's like 20. What is it, 20% from today?
That'd be about
15. Yeah, I think the lowest we go is like 380, like on the SPY, 380 on the SPY. But then again, SPY is very manipulated with because of FANG, right? So I don't think we break below 380. So right now, my whole thing is let's apply some caution. It's not, hey, let's get out of the market and just go straight into 100% cash, because I think in the next month, everything is going to go down. I think it's just right now, let's take a little bit of a step back and woosah, wait for the data to come out. No one ever lost money waiting. People lose money being early, but they never lose money being patient and just, taking some chips and waiting for that next hand to come. So
So I haven't actually watched this, but I just wanted to kind of bring into the room, another thought. And by the way, this is like the third or fourth time we've dabbled back and forth with 100 people coming in and being live with us. So appreciate everybody. That means a lot to us. We're having consistent back-to-back 100 viewer days, which is phenomenal. So I appreciate everybody joining us again. But I just wanted to bring into the room so we're not all doom and gloom. I'm curious to see what the other side has to say. So
of course,
let's just take a quick listen. Let me know if it's too loud or too quiet. Hot, Chris.
A lot of it, especially with the benefit of a little hindsight, looks pretty textbook.
Just
we
load up.
got the weak seasonal period, market at a high, August, September, October a weak, late October low off of a correction. Bond yields come down, retrace some of their gains. Where does that leave us right now? Because a lot of the complaints about this market going into this phase was it's too top heavy. It's only a few stocks working. Can the economy handle yields at this level? Where are we now?
Yeah, it was too top heavy. And what you're seeing now is a market that's broadening out and will likely continue to broaden out. The reality is we're in a nice patch here, which is inflation's come down and the unemployment rate has stayed low. So you look at a misery index, it's interesting. A lot of Americans aren't feeling good about the economy or about the direction of the country. But the reality is the misery index at 7%, which is unemployment rate plus inflation, is quite low. So this is a market that's likely to move higher. And it's going to be more of a risk-on environment than what we saw during that time of a top-heavy market.
It seems as if, you mentioned this kind of window that we're in right now, after the Fed has likely done all it's going to do on interest rates, the economy's still growing reasonably well, unemployment's still low. Usually there is a little bit of a period where markets can perform pretty well in there. Although this market, this cycle hasn't always conformed to these rules, I guess is one thing worth saying. But also, it still leaves us, though, with that persistent, aren't we in the latter part of the cycle? Aren't we just waiting for the lagged effects of higher rates to work on the economy and therefore corporate earnings?
Yeah, at some point, the economy is going to slow. It's been more resilient than many had expected. We saw a lot of mea culpas from people expecting a recession by now. But even in a slowdown in the economy, equity markets tend to do well. So as you think about 2024, the way we're thinking about it is we're expecting to come in with a market that's broadening, leadership in value, smaller caps, international, things that hadn't worked well recently. And then as the economy starts to slow, you tend to want to shift into more quality equities again. But to me, what I come back to is the principles of by the time you get to peak inflation,
Mhm.
which we had already 15 months ago, and peak tightening, you tend to see markets do well over the subsequent years. So even if we have some hiccup around the economy, call it late 2024, early 2025, history suggests that markets do well after inflation has peaked and come down, and that's over 2, 3, 4 years.
And unprompted, you did say your word of the day, which is peak, right?
Peak.
Yeah. Across the board, you're seeing that the markets kind of feast off of all that. Just quickly, where does it leave you with regard to those very large stocks that have gotten that quality premium in the NASDAQ that have driven the gains this year?
Yeah, I don't think it means that those stocks do poorly. I think it means that they underperform on a relative basis, which means you want to diversify. If you're an investor right now and you're sitting in money markets, which a lot of investors are, and you're sitting in growth stocks, diversify. So when the money markets move out and lock in some of those yields, go into corporates, municipal bonds, and on the equity side, add some value, small cap, international.
Interesting. Yeah. So, I mean, he doesn't say, we're out of the woods, right? I mean, I think he kind of is alluding to a lot of what your guys are talking about. I think he's a little bit where I'm at, though, right? Like, I think that we still have a little bit of time before you can really say that we're going to start hitting some sort of, I guess, recessionary sort of lulls. But he does say that, there's potential to kind of go sideways, pull back a little bit, but I don't think he's in the same woods. And I think maybe we are saying a little bit of the same thing, Chris. Maybe when I say recession, I'm thinking 30% pullback, or I'm thinking, and so you might be saying, a correction to slight bear market is about where we're going to be, versus the word recession to me, I think is where you start saying, look, you're looking closer towards a pretty large, 20 to 30% pullback. And I don't know if that's exactly what you're saying. So
No, I'm saying we could be in a period of stagnation a little bit, where you're not going to see a lot of gains, but you're not going to see a lot of losses, but it's going to be toward the downside, right? So the question is, once again, how do we make money during a time where the markets are flat or declining? So that's where I'm at. So right now, I feel like, and I do feel like I'm a little bit early, I think that we could wait another 2 weeks and 3 weeks and see how things are going and maybe eke out another 3, 4, 5% higher. But right now, I think the best thing to do is just be a little bit cautious, be defensive. Geopolitically, there's also a lot of tinderbox issues that are there, so I'm very hopeful that we don't get anything. Yeah, exactly. TJ's got the right buy, sell calls, sell puts, manufacture the win. That's what TJ does.
One of the things that I like most about that strategy, regardless of whether or not you're on the call side, put side, is one thing you can't change is time. Things will continue to go on. And so I think in this time period, you kind of alluded to it earlier, is like, if you're really uncertain, you actually are getting paid to wait sometimes now.
Yeah.
Right. With that yield, whether that, if you're in a 3-month treasury, a 26-week treasury, or if you're just sitting in a money market. Hell, Chris, we could have sat on whatever, $600 some in our public account and gotten a 4.99% yield. There hasn't been times, at least, and I've been in my investment career, where I think this is probably the first time in my investment career I've been able to do that. Since I started
a risk-free 5.5%.
Right. Yeah. Federally insured, backed by the government. Now, if you have over $250,000, it's a little bit different story, right? But that piece of it, and if you spread it around, right, you can get past that as long as it's not all in one account. But even still, you can call up your broker and say, and I've asked them before, I'm like, am I insured? And they said, yes, you're always insured above. We pay the extra insurance, yada, yada, yada. How true that is, I don't know. But, because I started worrying about that. I was thinking, I have to start opening up brokerage accounts every time I hit 250,000. Like, what the hell is up with that? But they said, no, everything's okay. But anyway, that's another piece, man. And especially depending on where you are in your investment cycle, say you're getting closer to retirement and you're like, hey, 1 to 2 years out from now, it's like, dude, take your money off the table, right? Unless you need for some reason another 50% gain to get to where you're at. If you're like, I don't want to lose this, dude, cash is cash is free at this point, right? We're no longer in the point where cash is trash, where you literally had to get rid of it to generate anything. You're at 5% yields just in a money market account. Like, that's just unheard of, right? Why put any risk at the market if you're a retiree? Hell, I'm just trying to get my mom to take money out of a savings account and put it into a damn like money market or anything that's yielding, because their savings account doesn't yield shit. So just double check. You're not guaranteed that all these savings accounts are going to make you money either. So some places, some checking accounts, they still aren't yielding you anything. So always just kind of be cautious of that, because sometimes they might make you feel like rates are going up, but you're not feeling the effects of it. So just be cautious of that.
Yeah.
Hi, Chris. We didn't talk about Atcor at all today.
You know what? Maybe after earnings tomorrow we can. Well, not tomorrow. Next week on Tuesday.
Next week on Tuesday. Okay, very
good.
When is Atcor earnings? I thought you said
tomorrow morning. I think it's tomorrow morning.
Got
I have to double
it.
check. Yeah, I think I may have flubbed on the wrong date.
Let me down,
earnings.
Chris. Let me down.
Let me see. It is tomorrow. I think it's tomorrow. Yeah, tomorrow morning. Let me just double check. Yeah, I think it's tomorrow morning. So we'll deep dive into them tomorrow morning. I'm not super hopeful that they're going to do exceptionally well, but we'll see. Atcor for me is like a nice long-term value play in infrastructure. So we'll see where things go.
Yeah. Well, I appreciate over 100 people showing up today. I know Chris and I kind of just banter back and forth about recessionary sort of fears and what we think. And I think at the end of the day, I think Chris has a lot of good points and something that I'm going to be watching out for personally. But, I personally always have a bias of being a perma bull. So, that's just me. And I know, Chris, you've been quick sometimes to take money off the table, which I think both are okay. And I think you just have to recognize where you feel is right and what your game is and how you feel, because sometimes what ends up happening is you might get a little overzealous and be too invested, and you might not like seeing the red, and you might end up, I've known plenty of people, and in 2022, they sold their portfolios at the bottom, and they did not get this 40% run up in the NASDAQ 100 in 2023. I'll tell you that.
Yeah.
And so, I know plenty of people that sold Google, and everything like that. And Google's had a hell of a restore in their share price over the past few months and quarters. So it just goes to show you're playing your own race, right? Chris and I are playing our own race, and we're pantering back and forth. Neither of us are going to be right 100% of the time, but we were watching this space as it develops, and to be very frank, this is just kind of unprecedented for me. Like, I've been in the market now for almost a little bit over 10 years at this point, and I've never been at a place where the federal funds rate was over 5.5%. So this is kind of new territory for me. And the last time I know that I was involved in a rate cutting cycle was in the latter half of 2018 going into 2019, and that was a pretty good bull run up to about February 2020, and then we know what happened with the pandemic. So, really excited to see where we kind of go from there. And I think that this is going to be a pretty good run up. I think we'll go back to all-time highs, if not extend a little bit above that before we truly hit some sort of recession.
So one thing I just want before we go, and just a quick thing. Watch the delinquency rates on credit cards. That usually will give you an idea of what's going on with the consumer. And one of the tragedies that I'm seeing right now that I'm not a big fan of is that consumer credit card default rates, like delinquency rates, they are on the rise, and they are not stopping by any means. Right now we're at this is Q2, so this is lag data. They're at 2.7%, which is higher than what it has been. Historically, it's still low. So don't get me wrong. But anyone thinking that, oh my God, this is a big problem. No, it's historically it's still low. But the trend is not breaking, and that's not a good sign. And you can see that it's actually above pre-COVID levels, right? So this is great financial crisis. Things kind of softened up, and then tighter, good lending standards. were applied and everything was great. And now the consumer borrowed. And now this may be a sign that the consumer is actually weakening and they're not paying their credit cards back on time. And so you're seeing that rise happen. Like I said, historically, still very low, but the trend is not trending in the right direction. And that's not good, So FYI.
No, that's good. Yeah, I think it's uncharted territory for me. And I think a lot of this is, I'm still rather young. I'm only, am I 32 or 33?
So someone said, and this is a good question by Dustin, why are default rates post-Great Financial Crisis much lower? Because lending standards were tightened up like there is no tomorrow. At that point, you just to get a bank to give you a loan, woo, boy, you had to be up there in terms of risk. In terms of like not having a lot of risk. So that's why. So risk actually was diminished significantly. So lending standards went through the roof. So that's why. Yep.
Yeah. Well, I'm kind of curious to see what happens. I mean, to me, I think real estate's been kind of pulling back a good bit. People aren't selling as many houses. Oil's coming down. To me, I think it's just ammo to kind of cut rates a little bit sooner. So we'll see. We'll see what they come up with. We have a month or so until they actually have to come up with a true statement for us at the FOMC level. So, Chris, as always, you went over above and beyond by 10 minutes. Hopefully, you get a little bit of rest. You've been going at it for about 2.5 hours now. So, I will talk to you soon. And as always, appreciate the 100-some people in the chat. And we're going to continue to build on this. So, the more love you guys show us, the more we'll hopefully get back to you guys. And hopefully, Chris, I mean, our goal with this whole thing, Cashflow Chronicles, is to be full time, right? 1 or 2 hours a day, every day. And think about how much time and I see this opportunity. I'll just take another minute. I see this opportunity of bringing on guests a lot more. There's a lot of people I've worked with on the YouTube community over time. I'm thinking like Independent Investor, Hot Dave from Hidden Freedom. A lot of people I've interacted with on X as well that I've met in person. Would love to have a lot of those people on and get all those different perspectives for you guys. And also an opportunity for you guys to, I think I've seen some channels like reaction videos of bringing on random people and being like, what are you invested in and why? And then just like completely trying to walk through it and be like, help them coach, right? And, we don't have the ability to be advisors in that respect. But, having that ability to be like, are you really invested in a TSLY? Like, why are you invested in that? What's the thought process? And there might be a very good reason, right? And we're just not really seeing it. And we're not here to shit on anybody's perspectives. We're here to kind of understand. And, if somebody comes on and they're a retiree and they say, hey, I have a dividend portfolio, I'm going to applaud them rather than them being invested fully into a speculative stock like Rocket Lab or something like that, because we're all running our own race, as we talked about. We're all kind of looking at what works for us. And so that's just the thought that I would love to see every single day and live out this Cashflow Chronicles dream to the fullest. So, Chris, thank you for being here as always.
All right. Take care, man.
Thank you guys. Bye-bye.